So we look today at the public sector and government, okay? And one thing as well, we kind of need to go back and look at the concept of market failure that was in a previous chapter. We didn't cover it in that previous chapter, but we'll look at the idea behind market failure, which is the justification for government being involved in the economy. But governments, the U.S. government has had a larger and larger and larger percentage of the economy in government spending, but still, compared to similar countries, our government spending as a percentage of GDP and our taxes as a percentage of GDP are significantly lower than they are in other similar countries, although that seems to be changing. So today we're going to kind of focus on taxation, and then we'll focus a little bit more on government spending and what we call public choice theory later on in the week. But basically, the first thing we have to understand is taxes are the monies collected by government in order to fund the functions of government. And again, we have debates over what are the legitimate functions of government. That's why we have elections, and that's why we have a constitution to kind of provide some limits on that government. And our elections, in a lot of cases, tend to try to tell them what we want. But again, even with that, personal biases and the desire to kind of reward the people who vote for you and punish the people who vote against you tend to, lead to policy not necessarily being done because it's the most efficient thing or the best thing for the economy of the country, but because it's the most efficient thing for me getting elected or reelected. And so that can cause some problems down the line because of the fact that the benefits are concentrated. The benefits are concentrated to a few people, but the costs are dispersed among many people. So all taxes are levied based on two principles, one of two principles. And this is a really important translation. This is one of those things. This is going to be on the test, okay? One of them is the benefits received principle. And basically the idea behind the benefit principle or the benefits received principle is that those who are using the service should be the ones paying for it, okay? If you go to a public college next year, you will pay tuition. Because the public college, like IU or Ball State, is owned by the state of Indiana, technically your tuition is a tax. However, you are the one who is benefiting from that education. So therefore, you are the one who, for the most part, is paying for that education. And so the idea behind that is you're benefiting, therefore you should pay for it. Gas taxes are another example of that. Gas taxes are primarily used to fund roads. The people who are therefore using the roads are the ones who are paying the gas tax. As a result of that, they are the ones who are paying for the maintenance of the roads that they use. If you don't drive a lot, you don't pay a lot in gas taxes. Therefore, you are not paying as much for the roads. Okay. Now, the benefits received principal taxes generally can be levied when there is a way of limiting access to whatever it is. Obviously, with roads, you've got to be able to put gas in your car, unless you own a Tesla, to be able to use the roads. And for those who have electric cars, some states have begun to institute kind of a fee to drive an electric car that would offset the loss of gas tax revenue. Again, so that those who are contributing to the wear and tear of the roads can use them. It's more difficult to establish, say, a tax for using the library or using a public park where there is free entry because of that. so as a result, those generally are funded by other types of taxes. So benefit principal taxations, things like gas taxes, college tuition, those who are benefiting from the service are the ones who are paying for it. An entrance fee to a state park that has, barriers at the entrances and require you to pay to use the park is another example of a benefits received principal tax. Those who are using the park are paying for it. So the ability to pay principal is the second, and that is basically the idea that those who make more money should pay more in taxes. So the taxes should be levied on those who are more able to pay them. And so the good example of this is the progressive income tax, the federal income tax that charges more and higher rates to higher earners. The problem with the ability to pay principal tax, there are several, but there's a couple. Number one, there's difficulty in determining how much more, quote unquote, rich people should pay versus poor people, or what is a fair amount of taxation. There are some who believe that everybody should be charged the same percentage. And that's what we do in Indiana with our state income tax, is that everybody pays the same percentage. Now, that still means that the CEO of Eli Lilly is going to pay a much higher amount of taxes than, somebody who works part-time at Frosty Boy. But it's still a large, it's still those who are able to pay more do pay more. The progressive tax then charges higher rates to higher earners. And now we've got, a debate, what is fair? What is a fair amount of taxation then? If we're going to tax one person more than the other, then what is fair in that? And you run into two problems with that. Number one is that you end up, one group of people ends up paying a lot but receiving very little benefit, and another group of people ends up paying little to nothing but receiving a lot of benefit, and so therefore taxes end up being used as a wealth transfer. And there are a couple of issues with that. Number one, there's the old saying that he who robs Peter to pay Paul can always count on Paul's vote. It's politically popular, and might be seen as a means of justice and fairness, but at the same time, what it does is it takes voluntary exchanges that would have happened, for example, somebody hiring to work a job, and replaces them with involuntary exchange where somebody is paying for something that they're receiving no benefit from, and other people are receiving something that they're not paying for. So, and so that leads to a lot of resentment. And again, it leads to imbalances in the economy because people are receiving something for nothing and people are paying something and receiving nothing. And as a result of that, you have kind of what we call a dead weight loss. You have slack in the economy as a result, because there are jobs that, for example, don't go filled or don't go hired, don't ever get hired. So there's three types of taxes. And again, this is very important. This will be all over the test, okay? There's a progressive tax, a regressive tax, and a proportional tax, okay? On a progressive tax, that means higher incomes, those with higher incomes pay a higher percentage of their income in taxes. So, in other words, the more money you make, the higher percentage you pay. And I'll give you a very simplified version of this, okay? Let's say we have somebody who makes $10,000, okay? They pay, let's say we charge them 5%, okay? So they would pay $500 in that tax. Somebody who makes $100,000, let's charge them, say, 10%. So they would pay $10,000, okay? Somebody who makes $1 million, okay? Let's charge them 25%. So they pay $250,000, okay? So this is a progressive tax. As the income goes up, okay? Notice the income goes from $10,000 to $100,000. The tax rate also goes up. We go from 5% to 25%. And as a result, these people end up paying the bulk of the taxes. The wealthiest people end up paying the bulk of the taxes. Okay, that's a progressive tax. Okay, as you make more money, the rates progress; they get larger. Okay? The U.S. federal income tax is a progressive tax. Okay, as the rates get larger, the rates get larger as the incomes get larger. Okay, and here is the federal income tax brackets for today, and you can kind of see this. We start out at 10%, and then for a single person making more than $9,876, it goes up to 12%, and that's every dollar up to $40,125. And then it goes up to 22%, and then to 24%, and then to 32% and 35% and 37% eventually. Now, these are what we refer to as marginal rates. And what we mean by that, and again, remember, marginal means the next one. So marginal tax rates, then, somebody making $100,000 does not pay $24,000 in taxes, okay? They only pay 24% on every dollar they make over $85,526, okay? Everybody, the first $9,875 of their income are taxed at 10%. For everybody, every dollar between $9,876 and $40,125 is taxed at 12%. Only dollar number $40,126 gets taxed at 22%. And this is a really complex calculation. And so when you file your federal income taxes, the IRS usually will do that for you. Rather, there's a book that they'll give you, or a PDF today, that just shows you figure up your income and it will show you how much you pay. So the opposite of progressive is regressive. That means people with higher incomes pay a lower percentage of their income in taxes. And in a lot of cases, regressive taxes basically tend to be things with flat fees. And understand the taxation is based on percentage of income and not necessarily amounts, okay? So let me give you an example of a regressive tax. Okay, back to the whiteboard here. We've got a person making $1,000, okay? Now, let's say that we have a $100 license plate fee, okay? Well, that $100 license plate fee is going to be 10% of this person's income. Somebody who makes $10,000, that $100 license plate fee is 1% of their income. Somebody who makes $100,000, that license plate fee is 0.1% of their income, okay? So it's regressive because as the income goes up, notice the tax rate goes down. The percentage everybody pays in taxes goes down, okay? This person, that license plate fee is 10% of their income. For this person, it's only 0.1%. So as you make more money, you pay a lower percentage of your income in that tax, okay? So the third type of tax is what we refer to as the proportional tax. That's where everybody pays the same percentage. So again, here, let's take a person making $1,000, okay? In Indiana, we have a 3.23% state income tax. So let's just use that here. So somebody making $1,000 would pay $32.30 in taxes, okay? Somebody making $10,000 would pay $323. Somebody making $100,000 would pay $3,230, okay? So what ends up happening in a proportional tax is that as the income goes up, the tax rate stays the same. The amount people pay goes up, but the tax rate stays the same. So this is a proportional tax. So know, again, the difference between the benefit and the ability to pay principles and the difference between progressive, regressive, and proportional taxation. So now, how do we calculate taxes? Okay, very simply, there's two ways to do this. Okay, number one, you can figure the average tax rate, which is the total tax due divided by your total taxable income, or simplified, the tax you have to pay divided by your income. That's your average tax rate. The marginal tax rate, which I just showed you, is based on the change in tax due divided by the change in taxable income. Your average tax rate is always going to be lower than your marginal rate unless you're in the 10% bracket. Okay, and remember, because marginal rates are charged on the next dollar. So, you know, and so if you know the amount of tax and you know the amount of income, you divide tax divided by income and you get the percentage paid in taxes. Now, if you have your income and you know the tax rate, you can figure out how much you owe, and that's just simply you take that equation on top and flip it around, take the income times the tax rate as a decimal, and that'll show you how much you owe. And when you figure out your state income taxes, because in Indiana they're proportional, that's exactly how you do it. You figure up your income, and then it just says multiply times 0.0323. This is how much tax you owe. Okay, so that's how to calculate taxes. And so, you know, I'll kind of give you an example here on average tax rate, and then give you an example on average tax rate here real quick. So, for example, let's say I made $100,000 and my tax was $10,000. Okay, actually, I need to do the other way around. It's tax divided by income. So my tax is $10,000. My income is $100,000. Okay, that's going to be 0.1, which convert to a decimal, or convert from a decimal to a percentage, is 10%. Okay, so it's tax divided by income. Okay, now if I have this, if I know my income is $100,000 and my tax is 10%, the amount of money I owe then is 100,000 times 0.1, which is $10,000. Okay, so income divided by tax rate, or times tax rate, as a percentage is the tax that you owe. Okay, so that's how to do the math on this and figure out how much those are worth and how much you have to pay in taxes.